In this video, we're talking about the 3 things you need to know about taxes on your Social Security benefits and a possible strategy to lower your taxes. Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're discussing how and when Social Security benefits are taxed in retirement. Now, this is an important topic because, as many of us all know too well, planning for taxes is critical unless you want an unwanted surprise come tax time.
Yeah, no one wants that, right?
No, they don't.
You know, Michelle, in my 24 years plus years as a financial advisor, how and when Social Security benefits are taxed are two questions I get asked over and over
But
again by retirees receiving their Social Security benefits. And the answer is it all depends. And I'll explain this in a moment. The first thing to understand is that Social Security benefits are subject to income taxes and it's progressive. The higher your income or how much you have coming in that is taxable, the more taxes you will have to pay.
okay.
And then how the IRS calculates what's taxable on your Social Security benefits is based on combined income, which is also called your provisional income. And there's a formula for this.
Okay.
What it is your total adjusted gross income or taxable income plus anything you have coming out of your retirement accounts, your tax deferred retirement accounts, plus 50% of your annual Social Security benefits. And that equals the number of how much you're going to be taxed on.
Okay, so let's break these down. Let's start with taxable income. What does that include?
Okay. This would be like earned income from a job, rental income, capital gains, whether it's short or long term, and any type of investments that you may have.
Okay.
Now let's talk about qualified retirement accounts and that are tax deferred, which could include like 401ks, 457 plans, 403bs, traditional IRAs, or even like a thrift savings plan. These are retirement accounts that are tax deferred, meaning when you paid into them, you got a tax deferral, and now you're going to take money out in the form of required minimum distributions. You're going to be taxed, and it's going to be taxed as ordinary income.
Okay, so we have taxable earnings plus the tax deferred income, and then 50% of Social Security benefits, which gives you then that combined income amount.
Yes.
So let's talk about Social Security tax thresholds, because this is different depending on whether you're single or you're married or filing jointly.
That is correct. Currently, if your provisional income is more than $25,000 for an individual or $32,000 for a married couple filing jointly, you must pay federal income taxes on your Social Security benefits.
Okay.
If your income is less than this, your benefits are not taxed. It's important to understand that the Social Security benefits that federal income taxes apply to include Social Security retirement benefits, spousal benefits, survivor benefits, and Social Security disability insurance.
Okay.
It's determined by the following. Up to 50% of your benefits if your income is $25,000 to $34,000 for an individual or $32,000 to $44,000 for a married couple filing jointly. Up to 85% of your benefits if your income is more than $34,000 for an individual and more than $44,000 for a couple.
And again, this will be taxed as ordinary income. So I can see from what we just went through that how if you don't plan, you could really end up losing a lot in taxes.
Right.
Yep. All right. So I want to talk about ways to minimize this taxation. But first, could you give us an example about how that formula, the combined income formula, might play out? Let's just say for a married couple filing jointly.
Okay, let's say you're a married couple filing jointly and your income's $60,000. Okay. And you have a combined $2,000 a month in Social Security benefits.
Okay.
Since you're already over that $44,000 threshold, you'll pay taxes on 85% of your annual benefits of $24,000 or $20,400. This is now added to the $60,000 of income for a total of $80,400 in taxable income for the year.
Okay.
IRS calculates your income as half your Social Security benefits plus your adjusted gross income plus any interest earned for that year.
Okay. All right. So we're going to drop a link below this video to an IRS calculator to help you calculate if your benefits are taxable. So do go check that. It's in the description below.
Yeah. Real quick note on that too. And a very important one. So far, we've only talked about federal taxes on Social Security benefits, right?
Right. State taxes. Ding, 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 ding.
Ding, 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 ding. Pay attention. There's also 12 states that also tax these benefits. These states include Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Vermont, Utah, and West Virginia. You'll need to check with your state if they tax your Social Security benefits and by how much.
Good point. Yes. Make sure that you do check with your state because, as we've learned from the past few minutes here, if you don't plan, you might get an unwelcome
Definitely.
surprise come tax time. All right. So I want to start. Let's get to the strategies on how someone can lower their combined income and therefore pay less taxes.
Yeah, one way, Michelle, is to utilize your tax-free accounts like your Roth IRAs, your Roth 401ks, Roth conversions to offset your combined income. If you have Roth accounts, you may decide to remove funds from these accounts first before IRAs and 401ks so they don't increase your taxable income. So
Okay.
you would be replacing your tax deferred income with tax-free income and keeping you under that taxable threshold.
Okay. And I just want to just get really clear here that this can get really complicated,
Right.
correct?
Yeah, and honestly, Michelle, you want to work with someone that understands the taxes each year for you
Sure.
to help you distribute these in the most tax efficient way
Well, and
each
that
year.
was my next question, which was, how critical is it for someone to work with not only a tax advisor, a CPA, but also a financial advisor who really understands how to best move money for you.
Yeah, exactly. You truly do, and a lot of financial advisors, even though they're not allowed to give or not supposed to give tax advice, honestly, they truly need to understand the tax situation for you because it ain't just about investing your money; it's also about the distribution of that wealth to you in a most tax efficient way in the future.
Sure. Okay. Awesome. Here's the thing. If you like this video, go ahead and hit that like button. Don't forget to subscribe, leave us comments, and share this with anyone you think might find it useful. We're going to put a link in the video below. If you're retiring in 2023 or you know someone who is, check out that video. It's really, really important. Some great tips in there. Again,
Definitely,
if we take anything away from today, it's the importance of understanding the rules and then planning properly. So.
exactly.
All right. Thanks, Brian, for everyone. And thanks to everyone who watched.
Thanks, everyone. Have a great day.